Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. Our focus this week is on CBN rate cut explained, what it means for savers, borrowers, and investors. The Central Bank of Nigeria's CBN Monetary Policy Committee MPC held its 302nd meeting last week, Monday and Tuesday, September 22nd and 23rd, 2025, to discuss recent global and domestic developments and the risks to the outlook. The MPC is the highest policy-making committee of the CBN and is composed of a 12-member committee, including the CBN governor. The MPC meeting is held bi-monthly, with one more meeting this year. At this meeting, the committee voted unanimously to 1. Reduce the monetary policy rate MPR by 50 basis points to 27%. 2. Change the symmetric corridor to plus 250 by minus 250 basis points around MPR. 3. Set the cash reserve ratio CRR at 45% for commercial banks, 16% for merchant banks, and introduce a 75% CRR on non-treasury single account TSA public sector deposits. 4. Maintain the liquidity ratio LR at 30%. This cut marks the first reduction in 5 years. Key terms simplified. 1. Monetary policy rate MPR, the interest rate at which the CBN lends to commercial banks. It anchors all other rates in the economy and is a primary tool for managing inflation. 2. Cash reserve ratio CRR, the share of deposits banks must keep with the CBN. With a 45% CRR, for every 1,000 naira deposit, 450 naira stays with the CBN while 550 naira is available for lending. 3. Liquidity ratio LR, the share of liquidity assets, cash and government securities that banks must hold relative to deposits, ensuring that they can meet withdrawal demands. 4. Symmetric corridor. This defines the range around the MPR for the Standing Lending Facility SLF and Standing Deposit Facility SDF. With the corridor at plus 250 to minus 250 basis points, banks can borrow from the CBN at 29.5%, which is MPR plus 250 basis points, through the SLF, or deposit excess funds at the CBN at 24.5%, which is MPR minus 250 basis points, via the SDF. This corridor affects overnight market rates, system liquidity, and short-term borrowing costs. 5. Non-treasury single accounts, non-TSA, public sector deposit. These are funds held by the government agencies outside the federal government's treasury single account framework. By imposing a 75% CRR on such deposits, the CBN ensures that banks cannot fully rely on these idle public funds for liquidity, thereby tightening system liquidity and discouraging misuse. What are the implications of the rate cut? 1. Lower interest on savings accounts. Because banks are required to pay at least 30% of the MPR on Naira savings, the minimum saving rate will slightly decrease to 8.1% from 8.25%. However, this depends on other conditions that vary between banks, such as limits on the number of withdrawals per month to qualify for interests. Savers looking for more income may choose time deposits or money market or fixed income funds while keeping an emergency buffer. 2. Decline in yields on fixed income securities. The MPR cut signals lower benchmark rates. Recent auctions already showed declining rates ahead of MPC meeting, and this decision reinforces that trend. Lower yields make fixed income investment less attractive for risk-averse investors, which could redirect capital towards more productive investments. Additionally, pension funds and institutional investors may see compressed returns, prompting diversification into equities or real estate. 3. Reduced borrowing costs. Over time, loan rates will reprice lower, though transmission may be gradual due to tight liquidity from the high CRR. As of July 2025, the maximum lending rate averaged 29.84%, while the prime lending rate was around 18.01%. Lower rates can ease debt service burdens, reducing defaults. For banks, this could mean narrower margins, but potentially offset by stronger loan growth, improved asset quality, and higher fee income. 4. Boost to the stock market. Lower borrowing costs enhances corporate profitability, especially for non-financial companies, by reducing interest expenses. This could increase the attractiveness of equities relative to fixed income. For banks, the effect may be mixed pressure on net interest income, but opportunities in higher lending volumes, fee-based activities, and better loan performance. Investors may also find dividend yields on equities more appealing in a low-rate environment. 5. Adjustment in the SLF and SDF rates. With the MPR corridor fixed at plus 250 to minus 250 basis points, the standing lending facility SLF rate decreases to 29.5% from 30.0%, and the standing deposit facility SFD rates dropped to 24.5% from 25%. This means that banks will now be paying marginally less when borrowing short-term liquidity from the CBN and earn slightly less when depositing excess funds overnight. The effect is to keep interbank market rates aligned with the new MPR, ensuring smoother monetary transmission. 6. Impact of 75% CRR on non-TSA deposits. By imposing a 75% CRR on non-TSA public sector deposits, the CBN significantly restricts the portion of such fund banks can use for lending. Only 250 naira out of every 1,000 naira remains deployable. This measure curtails banks' dependence on public sector liquidity, reduces speculative use of government deposits, and strengthens monetary control. However, it also tightens liquidity further, which could blunt the speed of monetary transmission from the rate cuts. Looking ahead, the next MPC meeting, the final one for 2025, is scheduled for November 24th to 25th. If the current downward trend in inflation persists, the committee may consider implementing another 50 basis point cut. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week. Bye.